Good morning. A fourth generation family office. Our family's wealth came from the automotive, telecom, and real estate sectors since 1903. Started with my great grandfather. Obviously, I'm working already on succession planning with my 4 children and all the other children in the family. We continue to be involved in these sectors. In the automotive industry, we're known as Soriano Motors, and now we're bridging into the United States for the first time as of in this year. So if that's a conversation we'd like to have, obviously would be interested to explain further. And telecommunications were what is considered an MVNO. Most recent example is Mint by Ryan Reynolds, sold to T-Mobile for $2.6 billion. So we're playing in that arena as well, and other private tech businesses as well. Thank you.
Hi, I'm Gaurav Mehta. I'm the founder and managing partner of Mehshah Capital. We're focused, and our vision for the firm is really, it's all healthcare focused investing in private equity. And our goal is to do 2 things, simply improve the quality of healthcare in the United States at a reduced cost. So what we invest in and what we focus on are solutions that actually revolve around that. And our kind of early stage strategies right now include value-based care and healthcare staffing. And so within the value-based care right now, we're working on the self-insured employer market, which has been rather untouched, and talk to you guys about that some other, separately. And then also on the senior population. So we're working on several acquisitions right now that are geared towards that. Happy to tell you more about it if interested. Thank you.
Good morning, everyone. I'm Christine Schleppegrell. I'm a partner here at Morgan Lewis, and I focus my practice on regulatory matters, specifically with respect to securities. So where that interacts with the family office space is really in 2 areas. The first is related to Tomer and Casey's presentation that just preceded ours, which is helping structure investments and ensuring that there's the lightest regulation possible on those so as to maximize the value of the investment and not have to spend unnecessary time and money complying with SEC regulations or other regulators. And then the other part is helping family offices stay out of the guise of the SEC and stay out of the SEC's sort of regulatory regime. And this is coming up increasingly when we have family offices that are also starting to engage in investment advisory activities as a side business, or maybe one person that's part of the family also has an advisory business, and trying to maintain that separateness so that the family can maintain the privacy that they want and they don't have their investments and all of those things viewed by the SEC.
Hi, everyone. I'm Chris Dlutowski. I'm a partner at Morgan Lewis as well. Very familiar faces from yesterday by welcoming remarks. I am resident in our New York office. I'm a private funds partner. The bulk of my practice focuses on representing institutional investors, including family offices in all different asset categories, from the most public to the most illiquid. And part of that illiquidity category would include private equity. And the investments really run the gamut from straightforward private equity funds to also all types of co-investments as well as direct investments. So thank you.
Good morning, everyone. My name is Joe Solari. I've come to these events as a participant for over the years, and now as a panelist. This is pretty cool. I've spent my whole career making private direct investments, managing private direct investments, and now helping other guys get the right jockeys for their horses for their private equity investments. Bain did a study in 2020 that certainly I saw loud and clear that the biggest driver of success and returns in private direct investments, private equity investments, is the team. It's having the right person at the right place at the right time to drive return. I've certainly learned that the hard way in investments I made and managed. And now I work as a managing director for Focus Search Partners. Our firm, 95% of our clients are private equity firms, and they're private equity backed companies. So I, again, spend my time trying to align talent with the value creation thesis to drive return.
Great, thanks. So you can see from this panel that we have representation from investing, legal, executive search, and even on the investing side, some different strategies here. But I'm going to start with you, Joe, because I think you mentioned something maybe a little bit controversial. You said the biggest driver for success is talent. A lot of people would argue that maybe it's multiple expansion, maybe it's industry, maybe it's timing. Why do you say it's talent, and how do private equity firms and investors leverage that talent?
Sure. I mean, I just was looking at the study that being the quality of portfolio company management study is the most cited reason for deal success and the second most cited reason for deal failure. I know the deals that I've done, that I brought investors to that work the best is because they had the right people at the right time to drive that investment thesis. So, you know, what you see is that as an investor, when you're looking at a deal or when someone brings a deal to you as a family office, you know, one of the things that private equity firms always do is do a quality of earnings. They make sure all the numbers line up properly. But what you're seeing now with the biggest private equity firms, and it's moving down towards the middle market, is what doing a quality of talent or QOT and ensuring that when you're going into the deal, you've got the right people to be able to execute your vision. You know, whenever you look at the CIM, the confidential information memorandum, when you're pitched a deal, or when you yourself are putting a deal together, say, I'm going to buy this company because of this, that, and this, and these are the things I'm going to do to it to be able to make you or make me 3 to 4 to 5x of my money, or whatever the return scenario is. So that's great. It makes an awful lot of sense intellectually, but unless you have the right drivers to be able to generate those value creation initiatives, to be able to execute the investment thesis, you're making it a lot harder on yourself. You're certainly going to take a lot more time doing so. And like the old adage says, you know, time is money. Well, in private equity and for direct investments or for private equity fund investments, as we all know who participate in them, time is indeed money. So the faster you have the right people in the right place at the right time, the better your chances are for achieving the returns that you're seeking. Pre-deal, the quality of talent, ensuring you have the right people, bring them in from the outside, use a search firm or your network, or bring in the experts to be able to judge, is this the right CEO to take us from 10 to 20? And then 2 years into the term, is that the CEO to take us from 20 to 50? And along the lines, across the org chart, who are the people that it's most important to be able to drive these returns? Do we have them now? 3 years into the deal, do we have them now? It's important to be able to monitor, along with the economic and the numbers, is who's driving them and making sure you have the right people in those seats.
Okay.
I have a question for.
Go ahead.
For Jeff, if I may. I'm just, as an attorney outside looking in, I'm very curious as to the circumstances that a family office that doesn't have that kind of personnel in-house. And what are the circumstances when they go to a firm like yours and say, hey, we need a person in-house? Why would they do that? And then are there certain market sectors that are particularly hot now?
Sure. I mean, primarily I work with the private equity funds themselves, as well as the you can think of a family office as, I guess, a private equity for making direct investments, where leveraging a firm like Focus Search Partners or others to be able to bring in the right interim executive. Look, we're looking at this deal. It's this sector, it's this geography. Do you have someone, can you find the right person who's been involved with successfully a company just like that, who can go in and help us kick the tires? PE firms may have operating partners to play that role. Many of the larger PE firms, Apollo, Blackstone, have human capital partners who will help then come in there and evaluate that talent. Family offices, individual investors should lever expert resources to be able to go in and ensure what the deal they're being presented is being presented accurately, that the people at the management team, that's a great management team driving the deal forward, has the expertise to be able to drive those returns they're seeking.
Marco, you're angling to say something. What do you got?
Well, I disagree with a lot of what you're saying. As a family office, just because it sounds great, and I think the functionality of a given business, even if it's my own vision or my family's interest and vision, is never translated into a person that has nothing to do with the family. So the best way that I have done this in the last 10 years is by setting up the examples. For example, I read about Henry Ford, the way he used to hire his staff executives. And it was very simple. He would take them out for dinner, talk to them, interact with them, and just observe how they interact with the surroundings, with the staff, with the people, with himself. He would also look at the way they would eat. And at the end of the meal, he will make a selection. And just to give an example, so the guy who was engaging the most with him was sucking up to him to get the job. Whereas the guy who was talking to the staff, the waitress, the bus stopper, everybody who was in attending of services was the guy that he wanted, really. Ultimately, when they had their meals and they both ordered steak, one guy ate the steak the way it was, another guy put salt on it and all kinds of stuff on it. So he made a decision, I'm gonna hire this guy instead of the other guy. He hired the guy who did not put any salt on the steak because he showed them by example that first you need to try things before you start making any modifications. And he also hired the same guy who was talking to the staff because he understood that it's more important to connect to the people that are servicing you than connecting with the actual owner of the company. So these are principles and traditions in families that if you do not pay attention to, it is extremely hard to find the right person. I have hired and fired the best dressed people, the best people that have gone to the Ivy schools. It doesn't necessarily translate into talent. Most recently, I took a guy on a trip for 24 hours with me all the way down to Dallas by car. He said, why didn't we fly? I said, because I love the road. But I want him to put him under the stress of driving that much to show me his real character. And by the time we were back, I wanted to kill him. And then I understood there's no way I'm going to work with this guy. And I said to him straight up, I'm not going to hire you. You're too difficult, under stress, and you're talking to who would be your actual boss. So there are things that you can do before you're going to hiring talents and staffing and all this stuff. I mean, lower tiers, I think is all right, but higher tiers, executives, you need to do the work. The family office, the owners, the family has to do the work and set that example. I'm sorry.
No, listen, I think we agree on the most important thing is that evaluating the talent of the folks who are going to be leading your business is a critical success factor.
On that, I'm going to move to our next investor, Gaurav. What are the key factors that you are looking for when you're looking at deals?
Yeah, absolutely. I mean, first and foremost, I don't back companies, I back people. And I think that's a really, really important distinction in private equity that is critical. Because in reality, especially in the way business today is operating, you're having to pivot as a leader over and over again. And that level of pivoting and innovation that's being demanded of businesses today is only accelerating. And so when I look for talent and I'm leading a company or I'm going to back a founder, for example, I like to see that they've had failures, that they've recovered, how they turned around and recovered, and sort of how they see the world evolving. And I spend a lot of time kind of understanding what they're about and what they're really kind of, sort of how they see the world going. Then I also spend, to your point, how do they interact with their team members? If I'm in a meeting, a diligence meeting, and there's only one person talking, the CEO the whole time, that's problematic. Because what you want to have is a strong CEO, absolutely, especially in a founder-led business. But you also want to have people behind him who feel like they can speak up and they can actually share their opinion openly, even to an investor, right? And so I look for those little things. It's the little things that say so much about a person. And so I look at those little things. That's what I pay attention to. And so then I make an informed opinion. Hey, is this somebody that I can actually trust, that their people trust them, that they can navigate choppy waters, especially if you're a growth stage company or you're sort of a lower middle market company? And if the answer is yes to all of those, then I think about the rest of the sort of fundamentals of the business, right? At the end of the day, you need to have a big market size. You need to have, I like to go personally for stuff that's a little more greenfield. So there's a lot of runway to grow. You gotta have strong unit economics, right? So it comes back to the fundamentals of a business once you get past management. And if you've got checked the box on good fundamentals, a good market, and an amazing leadership team, no matter what you model, which really is kind of irrelevant, that business is likely to be successful. And I have invested over my career with that exact template, and I've had a lot of success in doing that. And I'll say that, I don't mean to sound arrogant, but that's just the reality. So I think that's the template to success when you're investing. Don't worry about multiple expansion, because you know what? Multiples go up, go down. You never can control that. That's not something you can control. Margins, right? They are likely to shrink, especially if you're in an innovative area. So you gotta think about those things. But if you hit those other three areas really strong, at the end of the day, you're gonna probably have a successful outcome. That's my view.
You could have a successful outcome unless you get in trouble with the SEC.
Great transition. Ben.
There you thank you.
Love it.
Christine, how do we not get in trouble with the SEC, and what regulatory challenges are we facing?
Sure, that was a lovely transition. That was amazing. So I think what we're seeing with family offices is one of the major concerns is how to maintain that separation between the family office, which is exempt from investment advisor registration, assuming they've appropriately complied with the family office exemption, and then other parts of the business or other parts of other family members who are starting their own business, who may be starting an investment advisor business separate from the family office, but where you have common control and common ownership of both the family office and the other advisory activities, there becomes an increased chance that the SEC can play a role in the life of the family office. And so that's something we really try and avoid and maintain that separateness. So we spend a lot of time with our family office clients just trying to understand the family dynamics, which are very important, and also what's the business. So what is the family office focused on investing? And then what is this other investment advisor entity focused on? And a lot of times there's overlap, right? It makes sense to carry over those synergies. If the family is good at investing in this space and private equity and real estate, to carry that over on the advisor side. So we want to maintain those synergies while also maintaining enough separateness so that we can argue to a regulator that the family office is out of scope of the SEC. And so that's one of the things we really try and work on. That involves working closely with the family to understand their dynamics, understand how many hats someone's wearing. And a lot of times with the family office, it's many different roles that they're playing across those two entities. So I think that's one of the big regulatory challenges we're seeing, especially with the hyperactive SEC, very hyperactive regulatory environment. And you're seeing increasingly federal laws coming down, asking for reporting of beneficial ownership all the way down to the individual person. And family offices are not exempt from that. And so that's another thing, is maintaining that privacy and not having to report to a federal agency who the beneficial owner is of some of these investment entities.
Yeah, being a family office, does this all make sense to you? And are you following all these rules?
Yeah, I mean, we have the corporation that is publicly listed, which is separate from the private holdings. And yeah, one trade, one political contribution, one inside trade that you do can cost you a lot of headaches. So we are very careful with that.
Right. Christine, can you just differentiate a little bit between some of the items that are important to family offices versus dedicated private equity funds?
Sure, absolutely. So in terms of family offices, often they're looking at this from the investor side, not the sponsor side, or they could be both. There could be the family office investing in private equity and then also starting their own private equity shop. The sponsor side concerns from the regulatory perspective are more numerous, because you could be considered operating as an unregistered investment advisor if you don't qualify for an exemption, right? That's a big issue for the sponsor. On the investor side for the family office, we're also looking at due diligence. So family office is investing in private equity. How does the family office conduct appropriate due diligence? I think those were some of the questions posed to Casey and Tomer about how do we know if this is the right doctor that really is the leading person in this cancer research. The same with private equity. How can family offices get the information they need about the private equity manager, but then also the portfolio companies that the private equity fund will invest in? And what we're seeing is sometimes family offices are interested in private equity investments, sometimes not necessarily for just how much that fund promises to return, but instead for information about deal flow. What are the new companies in this space?